So first of all, just an introduction of myself and Geoff, who will be hosting today's webinar. So I'm the Chief Business Officer at Syfe. My background is mostly all in investments. So I started at Morgan Stanley as an equity research analyst, actually in Asian financials. And then, I was at a large hedge fund in Singapore for just over a decade, managing a global consumer and financial portfolio. And Geoff, who's also joining us today, is the market strategist at SGX. He has over 20 years of experience in the markets, and really excited for him to take you through perhaps some unknown facts about SGX and gems potentially that you can find on the market. Just a quick introduction of Syfe. So we are a digital investment platform with basically, we use technology to empower retail investors to grow their money confidently and enable them to really choose the future they want to live. We believe in providing best-in-class access and advice and affordability, again, through innovation and technology. And what does that all really mean? So essentially, we are an all-in-one platform for your investment needs. We have everything from our Syfe Wealth, where we started, which is our managed portfolios for those who want a more hands-off and passive way in managing their money. And then, we more recently this year have launched Syfe Trade, which is our brokerage platform for those who want to take a more active approach. And again, you can combine those two and have both the passive strategy and the active all in one platform. A little facts perhaps about little story about our journey so far. So we launched just over 3 years ago now in 2019 in Singapore. One interesting fact that we like to share is that we have a large age range, and actually our oldest customer is 94 years old. And that really speaks to the fact that it's never too late to start investing. The other thing, and which I talked upon on the technology and innovation side, which is big focus for us, is essentially we have launched a number of firsts in the market. Anything from our REIT Plus portfolio, which was actually launched as well in partnership with SGX, where we were the first to offer a REIT fund which you can invest in, which essentially mirrors the Singapore iEdge S-REIT index. We also launched our ETF custom portfolio builder, which was another Asia first, enabling you to further personalize your investments. Some of the other things that perhaps have happened more recently, we're very proud of what we've achieved this year. So we launched our trading platform in January, and we then followed up very closely with our launch in Hong Kong and Australia over the last few months. So now we are active in 3 markets in the region. We also were very proud to announce that we have now, that in the first quarter, we hit over 100,000 customers in Singapore alone. And now the most recent part of our journey is obviously what we're here to speak about today, which is the launch of SGX on our platform, enabling you to bring together SGX and US trading in one place. A quick overview of our products. So as I mentioned, we have the Syfe Wealth part of the platform, which is our managed portfolios. And this is for the more hands-off approach, passive investing, where you essentially want us to do the work for you and allocate in. Firstly, you can have your core portfolios, which will be your globally diversified investment portfolios, and which can be according to your risk levels. So, core equity 100 being fully equity and highest risk, followed by the least risk would be the core defensive, which would have a higher degree of bonds versus equity, for example. So we also, as I mentioned, have our REIT portfolio, which is if you want to essentially gain passive income, given the high attractive yields, particularly at the moment. And you have a strong view on the Singapore property market, which I'm sure many of you do. We also have our cash plus portfolio, which is essentially a cash management solution to earn an enhanced yield of 2.3% with no lockups, no minimums, quick withdrawals, which you can withdraw within the same day, etc. So no lockups, unlike for a fixed deposit. And then, as I mentioned, more recently we've launched our trade proposition where you can, well, first invest in US stocks and ETFs, and now you can also add that with SGX and invest in some homegrown companies as well. So really gives the full suite of products from both a passive and active perspective. So why SGX and why now, perhaps? Basically, we've done a recent survey of investors, and some of the findings have been, I think even quite eye-opening for ourselves, and has really shown us, why SGX and how important SGX is, for local investors, and increasingly so. So essentially, if we look at some of the results, SGX stocks and ETFs and REITs were basically double where for local Singaporeans, where they are currently invested compared to international stocks, and also importantly, where they plan to increase their holdings further, right? So 83% of our survey respondents said that they were currently invested in SGX, and 49% plan to increase that, so much more than international stocks, and also much more than even Singapore savings bonds and T-bills, despite the higher yield environment right now. And there are a number of reasons. For this, and I think there is, firstly, one of the popular respondents was on the high trust in the Singapore regulatory framework, and I think that's very very prevalent and very, perhaps has an increased importance at the moment, given what we're seeing going on in the world, both in markets, but also in the geopolitical situation, where we're seeing this flight to familiarity and to safety, and Singapore is really benefiting from that, and subsequently the Singapore market. Second is high dividend yields. We'll touch a little bit more on this later on, but there are a number of stocks and sectors in the STI which give a very significant dividend yield, and that is very popular among investors. And again, particularly right now, where people are looking for more passive income, for perhaps a little bit more safety in this volatile market. Finally, strong belief in the growth potential of future Singapore companies. So again, really around the resilience of this market, the resilience of the economy that we're seeing, both when we compare regionally and also, globally, where Singapore is held up, much better than other regions. And for those of you who are perhaps less familiar with SGX, just a high-level overview. So there are 550 securities on the SGX, 42 of which are REITs and property trusts. And I think one thing which is very unique perhaps to the Singapore market is the top sectors are almost 50% in financials and 20% in real estate. So again, speaks to the defensive qualities of the market. And what I've mentioned previously as well, and on the dividend yield side, very attractive market there, with REITs yielding over 7% and the overall market yielding 3.65%. And this just shows perhaps some of in numbers, some of the trends that I've spoken about, where year to date we have seen significant inflows, not only in SGX, as a whole, as a market, but particularly in the sectors that have those more defensive qualities, so financial services, REITs, and more out of consumer stocks, which is again what we've seen as well more globally. And this chart is something which I think was quite stark, to myself, even when I had my first look at this, and it really shows basically, well, it shows a few things, but let me maybe explain what this is, right? So this is essentially the 5 largest cap stocks. On the left-hand side, you have on the S&P 500, so Apple, Microsoft, Amazon, Tesla, Google, and on the right-hand side, the 5 largest market cap stocks in the STI, which would be DBS, OCBC, UOB, Singtel, and Wilmar. And you can see there, the year-to-date performance of these 2 markets in stark contrast, right? So we've obviously seen, significant sell-off, not only overall in US markets, but particularly, in high-value growth stocks, and that is in contrast, and has perhaps benefited other more stable and defensive names, such as the likes of the financials and Singtel, large telcos in Singapore, which again is that kind of flight to safety, much more reasonable valuations, etc. And that's one other point I wanted to make here, is about the importance of diversification, and why we're really excited about launching SGX, is because essentially, whilst the S&P stocks and the large cap stocks on the left hand side would have given you a strong performance if you had been holding them, obviously over the last few years, but in times of volatility, in times of drawdowns, when you diversify into other sectors and other markets, you can see significantly less risk in your portfolio, and pockets of outperformance, as we can see here. And actually, the correlation of SGX or the STI, I should say, to the S&P 500 over the last 2 years is only or less than 0.2, which means that it's significantly uncorrelated to the US markets. Again, a very good diversification sign and tool. And just one final chart, which shows the performance of the STI in purple compared to some of the large US markets and global markets, MSCI World, etc. A significant outperformance, and actually up for the year, which is not what many markets at all can say, right? So again, why we're really excited to speak more about the SGX market today and going forward. With that, I will hand over to Geoff.
Sam, thank you.
1 second, I'm going to stop sharing.
Yeah, I think I'm on.
Yes.
Hey, thank you. And thank you so much to the audience for bearing with me. We were supposed to do this, I think, last week, and I think that was even a cancellation as well. I have been unwell with a mycoplasma infection, and hence it's really affected my throat in previous weeks, and for that reason I just wasn't up to presenting, but I very much really wanted to do this and really excited to be here. Funny, I caught a mycoplasma but have not got COVID, but nonetheless, what I want to do now is to spend a good 30 minutes if possible, if that's okay, Sam. Otherwise, if the questions start coming through, just cut me off. What I wanted to do is really kind of I guess the key messages on the resilience and our comparative performances here that Sam was discussing. I guess I'll take it to just 1 or 2 more levels of granularity and look at it through the prism of the actual listed companies that we have here on SGX. So that's in essence what I want to do, and explain why we have so much resilience. What are the really fantastic aspects of Singapore that we love that actually do transcend into our stock market? There is just so much, not just at the big index and large cap level, but all throughout the market. So, I mean, when you consider the economy of Singapore is 400 billion Singapore dollars, but the market capitalization of our stock market here in Singapore is actually 550 billion sorry, what did I say? I said the GDP is 400 billion US dollars, and the market cap of Singapore is actually 550 billion US dollars. So we have a lot of representation, and this is not just international companies that are listing here, but largely driven by large Singapore companies that are trading and reporting revenue and basing assets, not just in Singapore, but across the world. So our key benchmark is the Straits Times Index, and as Sam was mentioning, this has been among the most defensive advanced economy benchmarks in the world so far this year. So we've had a total return so far this year of 5%, and that compares to a decline for the FTSE Developed Index of around 17%. Now, just as Singapore is a global financial hub with lots of new, exciting, innovative products such as the Syfe app, our financial services are a crucial cornerstone to our stock market. So the trio of DBS, OCBC, and UOB make up 20% of our total market capitalization. They make up 20% of our day-to-day turnover, and they make up 40% of the STI. Now that compares to the likes of the FTSE Developed Index, the S&P 500 and so forth, where banks make up much less share, around 5 to 7%. And in fact, banks globally only make up 5 to 7% of global market capitalization. So there's one comparative aspect of our market. The second point I wanted to make on that sector weightage is that defensive marginal return of the STI this year is really attributed, I guess, to the fact that we don't have much technology stock representation in the STI. Technology stocks are the big heavyweight of the FTSE Developed, the S&P 500 and so forth. But as you can see in this bar chart, as we said, the STI is majority weighted to banks, and there is one tech stock there, albeit it comes under the industrials sector, and that's Venture Corporation. But I think one of the really interesting aspects, aside from the sector perspective, is much like our trade-centered economy, close to half of the revenue that is associated with the STI in its weighted form is actually generated in countries outside of Singapore. And that's mostly within Asia Pacific, which means that we rank among the world's most defensive global stock benchmarks when you break up the revenue. The APAC ex-Singapore revenue that's associated with the STI, it's mostly reported to ASEAN, China, and Hong Kong. And that's a very logical relationship when you consider that Singapore's ASEAN neighbours, particularly Indonesia and Malaysia, make up more than 25% of our exports, while China accounts for 15%, Hong Kong accounts for close to 15% of our exports. So in the year to date, the three strongest STI stocks have been Yangzijiang Shipbuilding Holdings, Jardine Cycle and Carriage, and Sembcorp Industries. Yangzijiang Shipbuilding is based in Jiangsu. It has reached historical highs in its order books this year, while at the same time benefiting from the appreciation of the US dollar, the currency it sells its ships in, relative to the renminbi, where it has its costs. Jardine Cycle and Carriage is also an auto distributor that exports 90% of its revenue to Indonesia, selling the likes of Toyotas and Daihatsus in Indonesia. And Singapore also makes up some 60% of Sembcorp Industries revenue, which of course is undergoing this strategic transformation. So that's just a flavor, I guess, of how these key, I wouldn't call them themes, but cornerstones of our STI have played out in the year so far. Following the recent STI rebalance that we had in September, so we have these rebalances every quarter, the beginning of every quarter. In September, Emperador joined the STI, replacing Comfort Delgrove, and that stock maintains pretty small weight though, because it does have not a huge free float, which is the amount of shares that freely traded on the market. It has to be at 15% level, and it's not much different to that. So it maintains a pretty small weight in the STI, I think 0.5% thereabouts. It's Philippines' largest global liquor company, had a secondary listing debut on the 14th of July this year. Its first day close was 45 cents, and now it's trading around 48.5 cents thereabouts. But I guess the third key thing about these STI companies, and the first, obviously, as we said, the financial services hub transcending into the stock market, the international trade-centered economy, seeing a lot of international revenue associated with the STI. The third one is that Singapore does pride itself as a country that ranks very highly in business efficiency. And there have been a number of stocks that have been pursuing strategic initiatives to restructure or pivot to new business activities to add shareholder value, which can include acquisitions and disposal. So after these top rankings in the year to date, after the Yangtze Jardine and Sembcorp Industries, you can see the likes of Keppel Corp, City Development, and Singtel. So Singtel was reported this morning. It traded double its usual turnover today and rallied 3%. It's transforming its NCS business to a digital champion, and it has made a significant disposal this year of some of its stake in Airtel, and has actually surprised the market today by announcing it would have 2 tranche special dividend with the proceeds of that. City Developments is also following a strategic capital recycling initiative to unlock latent asset value. So disposals has been an important part of it. Keppel Corporation's pursuing its transformation to an integrated, sustainable urbanisation champion by 2030 under Vision 2030. And of course, as we mentioned, Sembcorp Industries has been among the strongest ones, but that's pressing ahead also with a strategic transformation of its portfolio from brown energy to 70% green energy by the year 2025. Other examples of strategic restructuring include Capital Land Investments, completing its transformation to a real estate manager last year. And then we saw Wilmar also list its YKA business in China the year before. So that micro aspect, I think, is also a really important aspect. So really, to sum up in this, I guess, these initial couple of slides, we have the strong representation of banks. We have a lot of international revenue reach, and therefore a lot of exposure to different growth drivers across the region. And number 3, that drive to enhance operational efficiency here in Singapore. We do see it at work in our stock market. Now, so far today, this is just looking at the net fund flow perspective. Singapore stocks have booked around 850 million of net institutional inflows. It's been led by the institutional inflows have been the strongest in Singtel, OCBC, Keppel Corp, City Developments, Sembcorp Industry, and a few REITs, Mapletree North Asia Commercial Trust, because of the merger earlier in the year. Sembcorp Marine is in that mix as well. Jardine Cycle and Carriage, Gunting Singapore, and Capital Land Integrated Commercial Trust. So that means that on a sectorial basis, you've got telecommunications, industrials, consumer cyclicals, the real estate developers and managers, so not the REITs, banks and utilities. They have all attracted the most net fund flows in the year to date. But the sectors that have not, the sectors that have been seeing the most net fund outflow or net institutional outflow are the REITs and technology. US restrictions on technology trade has been one of the 2 key drivers for the sector so far this year, as we saw last month in particular. The weakening demand for consumer electronics has been the other key driver. So the most traded high-tech related stocks we have in Singapore, besides Venture Corp in the STI, you have AEM Holdings, UMS Holdings, Franken Group, ISDN Holdings, as well as Grand Venture Technologies, GVT, and Aztec Global is also quite vibrant on a day-to-day basis when it comes to trading turnover. But nonetheless, technology has been the weakest performing global stock sector from the outset for the year. So you've got inventories, you've got capex, earnings, guidance. They're among these critical key industry metrics that are currently being scrutinized in the current earnings cycle. REITs have also been among the weakest of the sectors globally. There's been this growing hawkishness of the US Fed Reserve and expectations building in recent months that rates will be higher for longer than originally thought. So currently the Fed funds rate is at 3.75 to 4%, and the peak rate or the terminal rate is expected now to be 5 to 5.25%, all the way through to September next year. And what that does is create a very fluid market, because the asset classes, the bonds, the currencies, and the relevant equity markets are super sensitive to the outlook for rates. And that's obviously been driven not just from inflation, but also from growth as well. And also the Fed Reserve is actually using its language to also curtail inflation expectations. And because of the importance of Fed speak, we have seen basically markets move quite considerably on a short-term basis. So for traders that are looking at the global markets, obviously, you can have US dollar index swing 2% in 2 sessions. Once upon a time, US dollar index might move 5% a year. So the impact that has across the different asset classes, I think, is creating very dynamic market conditions, which has suited more traders. But I'll move quickly because I don't want to get. I can digress sometimes, so I'll try and keep to the slides. As we said, banks are a really important part of the STI. They borrow short, they lend long. They maintain positive correlations with their net interest income to US interest rates. So net interest margins are largely determined by the average rate paid on the liabilities versus the average rate the banks receive on their assets being their loan book. That contributes to net interest income, along with the size of their loan book and the ability to grow the actual loan book. Now, on the back of the higher interest rates, last week we had DBS, OCBC, and UOB complete their third quarter financial updates. The trio reported a combined amount of 7.4 billion Singapore dollars. That was up 1.3 billion Singapore dollars from the second quarter. It's the highest that they've reported. And I don't actually have it in this charts actually hasn't been updated, but if you can imagine this bar, these bars, they're actually just gone past that 7 level for the third quarter. It also means that there was the 8th consecutive quarter of quarter-on-quarter net income growth. Now, this is related to the actual interest rates. Even though the monetary policy here in Singapore is the currency band, and over the past 12 months, there's been, I guess, 3 recenters, and there's been 3 slope changes to the band. But at the same time, we have our SORA 1-month compounded rate, which provides a benchmark for interest rates. Now, that's moved from, where was it? It was 0.99% at the end of June. It's moved to 2.2% at the end of September, and it's currently around the 3% level. So that SORA rate is basically a benchmark rate representing volume-weighted average rate of borrowing transactions in, obviously, that what we call the unsecured overnight interbank Singapore dollar cash market. And that's continued to rise, as we say, to above 3% now. Now, the other key determinant, obviously, of net interest income, big part of the bank's net profit, is the size of the loan book. And that has continued to grow in line with the year-on-year guidance that had been provided previously. So we're looking around the mid-single digit year-on-year, 6% growth thereabouts for the trio. And really importantly too, the non-performing loan ratios were also reduced for all 3 banks from the second quarter. So what we saw for the full first 9 months of this year, DBS has reported 8% net profit growth, UOB's reported 12% net profit growth, and OCBC has reported 14% net profit growth. So DBS, OCBC, UOB, they rank among the 10 largest weights also of the FTSE Developed APAC ex-Japan Sustainable Yield Index. Now, I'm bringing this up because we have this great branding of being a high yield here in Singapore. And it's actually the 3 banks themselves, as we said, 40% of the STI, 20% of the total market cap, which actually provide much of the branding of having that high yield. In fact, that index, that FTSE Developed APAC ex-Japan Sustainable Yield Index, it's actually a thematic index that tilts towards the financial and the operating strength of stocks, with specific emphasis on companies that have really strong balance sheets and the ability to generate cash flow rather than looking at extreme high yields. And those three stocks, DBS, OCBC, UIB, rank among the top 10 stocks in that by market weight in that actual APAC ex-Japan index. So moving quickly to the REIT market, local regional reopenings, they have been a key theme for the S-REITs in the first 3 quarters of this year. And it has the sector, even though, as we said, the sector has been one of the global underperformers, it has continued to attract more than its fair share of investor activity. And so this sector makes up 10% of our total market cap, and it makes up 20% of day-to-day turnover. Now that's pretty big as well. There's around 800 REITs listed across the world that make up around 2% of total market cap. So again, we have our comparative strengths in REITs when it comes to market structure of the Singapore stock market. The REITs have been around too, I should mention, in the US since the 1960s. And while they make up, in terms of the number, they make up only around a quarter of the 800 REITs listed across the world. The US listed REITs make up 60 to 70% of the total market value of all REITs. So this means that US REITs and the relevant drivers of the US REIT market, they do have a significant impact on the overall tide of fundamentals and valuations of the global REIT market. For us, we have as many as 17 of our trusts exclusively investing in properties outside of Singapore. We have another 20 of the trusts that are investing in properties in Singapore and outside Singapore, and just the 3 REITs that are investing exclusively within Singapore. Across the S-REIT sector, we have 80% of the trusts owning and managing overseas assets across Asia Pacific, the US, and Europe. S-REITs are now one of the most international REIT markets across the world. Of the case in point, of the 8 industrial REITs, there's just the one that exclusively lists in Singapore properties. And that's really understandable when you consider the role that warehouses, depots, and logistics centers make in global trade. So the trusts are also highly diversified across those property types. So it's not just industrials, it's also retail, office, hospitality properties, in addition to multiple REITs investing in healthcare-related data centers and so forth, specialized type of properties. Now, at the end of September, the average distribution yield of the listed REITs and property trusts stood at 7.2%. That trumped the STI yield of 4.1%. It was higher than the MAS Singapore benchmark 10-year bond yield of 3.5% and higher than core inflation at 5.1%. In terms of debt levels within the sector, it maintains average gearing ratios, which obviously represent, I guess, what is it, total debt divided by total assets. And the average debt level is around 37%, which is lower than the regulatory limit of 50%. For the REITs and trusts, a lower gearing ratio indicates a greater capacity to undertake more debt when needed for future acquisitions, while the higher gearing ratio can obviously lead to credit concerns, especially during economic downturns. And we are expected to grow between 3 and 4% this year in Singapore, and expected to grow below trend next year. In terms of the hedgings and so forth, it's on average, the REIT sector has secured 75% of their borrowings on fixed rates. And despite the challenges of the past 2.5 years, thought it might be useful to share that S-REITs have also taken a very proactive role in their capital management. So that business efficiency, drive to increase shareholder value in the companies has also transcended to the REIT sector, with the REITs looking to increase unit holder value. You can do this by divesting properties, recycling properties, asset enhancement initiatives, acquiring properties, in some cases merging the REITs. Portfolio acquisitions, they don't just have to be funded through debt, but they can be done through secondary fundraising, such as placements and rights issues. And we saw close to half of our S-REITs listed on SGX last year announce asset acquisitions valued at 12 billion Sing dollars in total purchase consideration. And this year, we've seen another dozen REITs announce acquisitions that have been valued in the vicinity of $7 to $8 billion thereabouts. So I guess two things to watch through these numbers, and the numbers have still continued to filter through this week. I think Fraser Logistics and Commercial Trust reported its full year today. Special one for me because it's majority weighted to Australia, and yeah, always love the Australia connections with Singapore, obviously. I should mention that investors that are concerned on the ability for the REITs to raise rents in line with inflation and with the outlook for decelerating growth, the rental reversion is a key metric to show whether new leases signed have been higher or lower than the rental rates before that. Investors could also consider when the REIT tenants are due for rental renewal, and you can juxtapose that with the economic outlook. So if there's likely to be a positive rental renewal, it can be better for short-term leases. But if it's not likely to be a positive renewal due to corporate belt tightening, for instance, then longer leases might be preferred. So one more metric you can bring into that is the weighted average lease expiry, the WALE. It's a key metric used by the industry to measure the tenancy risk of a property. So that takes into account the tenant's area or income, and importantly, what remaining leasing years is there, and then you weigh that according to the total combined area or the total combined income of all tenants. So a really important part of our market. But this one, I did this slide just for this presentation, actually. Sam, this is stocks with significant trading turnover increases this year. So the benchmark I'll always be able to present on, but what I also love to do is look beyond the benchmark and look at some of the stocks that are seeing significant increases in trading turnover. They're there, and they're there every year. There's 10, 20 stocks that see very strong pickup, not just in trading turnover that's been driven by price increases, but a lot more volume than we saw the previous year. The thing is, you don't necessarily see it filter and cascade through to the high level because a lot of these stocks are pretty small. So you could have turnover growth of a stock that might only be trading, $1 million a day, and it's 100% turnover growth to $2 million a day. It doesn't really move the overall turnover of our stock market, which is around $1.2 billion a day. But nonetheless, they are there. And among the most actively traded stocks, there's been 3 upstream energy plays, 5 industrial stocks, and 4 REITs or property trusts. And that list, as we say, it does change on a year-to-year basis for a number of reasons that stocks seeing significant increases in trading turnover. You can have turnaround financials. You can have macroeconomic trends such as the supply chain pressures on commodities, which has seen increased trading in CPO plays. So you've got First Resources, Bhumitami Agri, and Golden Agri Resources all here because of the supply chain constraints from the Ukraine crisis on sunflower oil. We've seen a lot more demand for crude palm oil products that are majority produced in Indonesia, Malaysia, and this is relevant to these 3 stocks. But we're not just seeing the heavy rain at the moment here in Singapore, it's also in Indonesia and Malaysia, which is also having an effect on those CPO prices. You also have energy stocks that have been among the strongest performers this year, obviously, and you have 3 of the stocks, 3 of the 4 upstream plays that trade regularly and are among the more traded energy stocks. That's Golden Energy and Resources, Geo Energy and Resources, and Rex International, while the 4th, which is RH Petrogas, was on this list last year. Okay, so I guess coming in, a couple more minutes just to sum up some of our economic prospects here in Singapore. Look, as we said, our GDP is expected to grow at 3 to 4% this year. It's been lifted by the services economy, domestic demand, and regional reopenings, as Samantha was talking about. That has seen retail sales up 11.3% for the first 9 months of this year. Inflation kind of works into that as well with the retail sales growth. And looking forward, Singapore's GDP growth next year, as we said, expected to decelerate to below trend levels because of the 3 or 4 things, the overarching themes of global growth, global trade, inflation, as well as the Ukraine crisis. So inflation is expected to persist. It's expected to be above trend in 2023 at 6.5% across the world. So it comes down a little bit from 8.8% this year down to potentially 6.5% next year. Also in Singapore, our inflation is expected to be in that vicinity. So it's grown 5.9% so far this year, and it's expected to grow between 5.5% and 6.5% next year, which includes a 1% upward move because of the structural impact of the GST. Now, just as I guess, as we say, services have been comparatively strong, they also very well represented by the various sectors within the STI and beyond the STI. So you have services relevance in banks, consumer subsectors, broader financial services. You got healthcare services, and some industrial subsectors as well, real estate, technology, telecommunications. Services in all make up 70% of our GDP here in Singapore. Manufacturing makes up around 25%, and then construction makes up 5%. So you will see on a day-to-day basis, probably similar, but not exact match. You have probably around 20% of our day-to-day turnover is in manufacturing stocks, and definitely less than 5%, maybe 2% tops related to construction, maybe 1% tops related to construction, with the remaining very much related to services. The local manufacturing too, we could do it. Sam, we could do a presentation just on the manufacturing stocks alone. Maybe another time, or maybe going into next year, because this one's really interesting too, particularly with the tech stocks and the REITs as well. So you can see where I've got the industrial production here, which is the manufacturing. You can see it's been quite sublime this year at 3.9% for the first 9 months of this year, after very strong 13.2%. And this absolute surprise and resiliency of 7.3% growth in 2020. Now, this also, as I said, a lot of these trends transcend into our stock market. If you consider that, and not just in Singapore, but across the region, consider that industrial REITs were comparatively defensive as well in 2020 and 2021 compared to this year. So when global trade was outpacing global growth in 2020 and 2021, manufacturing was able to remain largely resilient through the region. And for those full 2 years of APAC, all the industrial REITs listed across Asia Pacific, which are comprised, as we say, of industrial parks, warehouses, depots, and logistics centers, they actually averaged 28% total returns over those 2 years. And you take every other APAC listed REIT, and they actually generated a decline of 4% over those 2 years. However, as we say, the broader manufacturing sector, it has been impacted by higher input and transportation prices. That's that inflationary effect, the growth slowdown in China, obviously, and a downturn in the global electronics industry, in addition to a high base rate of 2021. So that's seen our industrial production, which is 40% weighted to electronics, of which 4/5 of that 40% is actually semiconductors. That's weakened this year to that 3.9% growth over the first 9 months. And at the same time, risks that we continue to look at the end of the year going into next year is, of course, very much hinging on China, because if you look on the NODX front, we've had NODX growth of 9.1% in the first 9 months of this year. We have seen exports to China decline by more than 30% year on year in September, and decline close to 20% year on year in August. Thus, China's economy does remain a key variable to NODX, as well as many of our stocks. And also, as we said in the beginning, we've got that international connection, not just with China and Hong Kong, but also Southeast Asia. And the IMF expect our trade partners in the ASEAN region, Southeast Asian region, to enjoy a strong recovery going into next year. thanks to robust consumption, robust services, and robust exports. But the region is also very much going to take its cues from the US tightening cycle, because that has the potential to drive more regional currency depreciation, and thus we import more inflation. So I think in summary, the economy here in Singapore continues to move forward, albeit unevenly. There is that persistent global inflation pressures, the slowdown in China, the Ukraine crisis really continue to provide those broad headwinds, which basically brings you macro risks to a tilt to the downside. But as we said, we have remained comparatively defensive. A lot of that comes to the actual market structure and the composition of our stock market, not just from a sector perspective, but where in the world we're actually having those stocks conduct their business. So delighted that Syfe have SGX on the platform now, and I would invite you to become a little bit more reacquainted maybe with our stock market, and we're really looking forward to partnering Syfe as well in any education initiatives that you might want, Samantha.
Great, and thank you so much for that, Geoff. Very, very insightful, and I've certainly learned a lot about more about the Singapore market as well. Perhaps I am going to move on to the final part of the presentation, but I do want to ask maybe a couple questions before that. So we've seen obviously a very strong performance, as we've both mentioned, on the Singapore market this year. It's really been an outlier. Now, I guess the key question that people would have in their minds is, what are the risk factors? What should we be looking for any of these trends to potentially reverse, right? And I guess particularly when we look at the bank stocks, which have led, a lot of this outperformance.
Yeah, from an economic perspective, so if I take geopolitics out of it, which obviously can move pretty quickly, it's the wage price spiral. What's happened is the narrative on that central banks have on controlling inflation has really heightened to very hawkish levels this year, because what happened was this was all structural. This was just energy prices, COVID, reopening demand, which would have this one-off impact on inflation, and then inflation would kind of taper off the end of the year. But what happened mid-year is it actually became systemic. So the inflationary expectations that came with the high energy prices in Europe and the US and across Southeast Asia to an extent basically started morphing in to services inflation. So services inflation was taking its cue from that. And Jerome Powell, the Fed Reserve Chair, and in fact all the FOMC voters, they subscribe to the theory that it's actually inflation expectations are the worst driver of inflation, and very much a true thing. So once that started happening, that's when the hawkish narratives really started to flare up, and that's why your terminal peak rate is now 1% higher, and for a lot longer than where we were expecting it to be, say, 3 months ago. So the wage price spiral is not expected at this time by any World Bank, IMF, or any of the leading economists, but it is a real risk. And that's the one big risk that could see, that's when you have basically interest rates going higher, quite a bit higher, to control it. And look, as we said, we're not expected to make massive headwinds next year in inflation. Global inflation, it's gone from 4.7% in 2021 to 8.8% this year, expected to be 6.5% next year, and won't actually come down to 4.1% until 2024. So there's a long time of risk there that things can morph in economies, political pressures can come in, and you can see wages going up. And when wages are going up while global growth is slowing to 2.7% next year, global trade growth is expected to decelerate next year to 2.7% as well. Global trade growth was 10.1% last year. You've got inflation really outpacing the growth, and that's the big one risk, Samantha.
Got it. And maybe one question and related to that, right? And until I move on, is that now for the banks, as you mentioned, right? Obviously, benefiting from higher interest rates, positive to their net interest margins and their profitability. Now, credit costs have been so far contained. Is there a risk there in your mind,
Absolutely.
right?
Absolutely. So there's really three ends when it comes to the banks. It's the net interest income, which is net interest margin driven. That's fine. That moves with the higher interest rates. But the other part of it is the loan growth. If economic activity slows and no one wants to take out new loans, that means that has a dampening effect on what and can offset that positive from the interest rates. The second one is the non-interest income, and that's wealth management. That's services that it's a very competitive field ground. There's the disruptors coming up with great little apps where you can actually do all your own financial planning and so forth, and you don't need to use the services of the big banks. So it's a very competitive field. Digitalization is the massive growth enabler there. That went really well. The non-interest income was a very strong point for the three banks last year. It hasn't been this year because liquidity has come out of the markets. Markets still move and you still have these rotations and so forth happening. It's just that it doesn't happen with so much bandwidth that we have in less tightened monetary conditions. So that's important. But if that growth does taper off, then yeah, the NPLs go up. And you might remember the second quarter when it came to the three banks, it was a little bit different than when they reported their half years. DBS and OCBC actually reduced their NPL ratios. I think it was from 1.7% to 1. No, it was they reduced their NPLs, I think, from 1.5% to 1.3%. But UOB had to increase it from 1.5 to 1.7% because of some exposure to the China property sector, albeit not much. But that saw a very big different performance in the share prices. So UOB share price declined while the other two went up, because NPL is that third N, which is a really key, a very, very key variable. So that's the one you got to watch, and that is very closely tied to the prognosis for global growth.
Great, very clear, and thanks very much, Geoff. So maybe I will close with just an overview of our trade app. I can share my screen again. So I'll just open with a quick video of our app that's working. So as you can see, a number of exciting, oh, sorry about that. So as you can see, a lot of exciting stocks and companies to explore more about, on the Singapore market, as Geoff has taken us through, and really excited to have SGX on our platform and be available for investors. So essentially now you have one place where you can invest in both US and Singapore stocks. We have made a significant number of improvements to our user interface, etc. As you'll see if you open and explore the app now. I'm very excited about those. Very easy to use is definitely a common feedback that we get. Access to real-time market data analysis is also a key feature of the Syfe trading app. You can also get access to analysis and estimates from top Wall Street analysts, which also cover not only US but also Singapore stocks as well, and that can help you in your journey in terms of having some insights from what experts are saying about specific stocks. If you don't know where to start, we have a feature of the discovery list, where essentially you can learn more about both, again, the US and Singapore markets. You can look at themes specifically. Perhaps if dividend is very important to you, you can look at stocks which have high dividend yields, and we've screened those out for you. You can look at ESG favorites. You can look at sectors in terms of banks. If you're interested to look more into the banks, as Geoff has spoken about, and also top movers and gainers. And again, you can find some of these perhaps smaller cap gems that Geoff has also taken us through today. So the app is essentially very affordable, low pricing, no minimum and no account minimums, and no inactivity fees. Just a overview of our pricing. So for the US market, for the first 3 months, we have 5 free trades a month, followed by 99 US cents per trade thereafter. And after that introductory period, it goes to 2 free trades and 149 per trade thereafter. For the Singapore market, it is a minimum of Singapore dollars 1.98, and subsequent, after that, it will be 6 basis points of traded value if your trade value reaches above that minimum. And just a quick comparison here, and perhaps as Geoff mentioned, we are one of the players going after that non-interest income of the banks, and you can see here much more competitive pricing. If I compare to some of the other comparable apps on the market to trade SGX, if you look at a DBS Vickers, for instance, they would be at a minimum rate of $25 versus $1.98, and if you are trading large amounts, that cost will significantly increase, because we have a 6 basis point, and they're well above 20 basis points per trade for larger amounts, right? So significant cost savings from trading on the app as well. We have an exclusive promo for this webinar, Trade SG, for anybody who wants to sign up and start their investment journey with SGX now. And you can input that in your sign-in process and claim $50 to buy any stock of your choice. I think we've actually hit over time, and we've answered actually online most of the questions that have been asked. Geoff, any final words of wisdom from you, perhaps?
No, just thank you so much, and really look forward to working with you again, I hope.
Thanks so much for having you, Geoff, and thanks everybody today for joining us.
Thank you so much.
Thank you.